Imagine writing a check for $4.5 billion. You're acquiring this massive pharmaceutical giant, and you are totally convinced you've just bought your way into a completely new global market.
Right. It's the ultimate corporate dream. You sign the papers, the press releases go out, the market is cheering for you.
Exactly.
Yeah.
But then you actually get into the integration phase. You look under the hood and you discover these just catastrophic regulatory compliance issues. Like the FDA is issuing warning letters.
Oh, yeah. Manufacturing facilities are totally compromised.
Yeah, so overnight, you haven't bought explosive growth at all. You've basically bought a multi-billion-dollar corporate death sentence. The entire asset is just toxic.
It is, it's the absolute nightmare scenario. And I mean, honestly, it happens way more often than people outside the industry even realize. You really think you're buying a pristine revenue stream, and you end up acquiring a black hole of liability.
Well, welcome to the incredibly lucrative, profoundly dangerous, and frankly pretty murky waters of mergers and acquisitions. If you are listening to this right now, you are likely an MBA student, or you're gearing up to step onto a corporate strategy team.
Which means we don't need to explain the absolute basics to you. You know what a balance sheet is.
Right, exactly. You need to understand the actual mechanics of how these overnight empires are built and how they're destroyed. Okay, let's unpack this. Today's mission is essentially a masterclass in M&A. We're drawing from Unit 19 of a really comprehensive corporate finance textbook to deconstruct corporate restructuring.
Because, for your MBA journey, this isn't just about passing an exam. It's about understanding the reality of external expansion versus slow internal organic growth. In the corporate arena today, you can build a house brick by brick over 20 years, or you can just orchestrate a leveraged buyout of the mansion next door.
I love that analogy. But it's risky, right?
Oh, massively, because that mansion comes with all its furniture, all its structural flaws, and, all its existing staff. M&A deals strike like lightning. They instantaneously and fundamentally alter a company's financial DNA, its market cap, its operational reality, everything.
Yeah, and understanding the how and the why behind those lightning strikes, that is exactly what separates a standard analyst from a real deal maker. So we promise that by the end of this deep dive, you will understand these concepts inside and out, and more importantly, you'll actually remember them.
Right, because we're going to break them down with real analogies.
So let's ground this in reality by zooming out first. We need to look at a specific macro environment where the floodgates just completely burst open. We're talking about India post-1990s.
Essential context. You really can't understand deal structuring if you don't understand the macroeconomic climate that enables the liquidity for those deals in the first place.
Exactly. And the historical record here points to a massive catalyst, which was India's entry into the LPG era, liberalization, privatization, and globalization. But, beyond just the acronym, what did dismantling that old system actually do to the capital markets?
Well, it completely rewired the capital allocation of an entire subcontinent. I mean, prior to the 1990s, you had an economy functioning under really heavy state control. The license raj.
Right, where everything was bogged down in red tape.
Totally. Corporate expansion was suffocated. You had quotas, strict foreign exchange controls, huge bureaucratic hurdles. Liberalization stripped away those tariffs.
And then privatization comes in, right?
Yeah, privatization allowed highly efficient private capital to suddenly flow into sectors like telecom and aviation that were, previously state monopolies. And then globalization integrated India's capital markets with global liquidity pools. Foreign investors could suddenly deploy capital into Indian equities.
So you basically have a perfect storm. Rapid GDP escalation, shifting fiscal policies, higher interest rates, and this huge, unprecedented influx of excess capital just desperately looking for yield.
And the data from this specific era is just staggering.
It really is. I mean, looking at the source, M&A volume in India leaped from $21.3 billion in 2009 to $67.2 billion in 2010. That's a tripling of deal volume in 12 months.
Which is wild, and then it gets crazier.
Yeah, in the first quarter of the following financial year, the market saw a 270% increase in M&A deals, a 270% jump in a single quarter. That's not just growth. That is an absolute frenzy.
It was a frenzy. What's fascinating here is that it was heavily driven by cross-border transactions. It wasn't just domestic companies consolidating. You had massive foreign multinationals targeting India to capture, the demographic dividend and the rising middle class.
Right, but it went the other way too, didn't it?
Exactly. Newly emboldened, highly capitalized Indian conglomerates went on the offensive. They were hunting globally to acquire intellectual property, establish brands, and new market access in Europe and the Americas.
A literal two-way street of billions of dollars.
Yeah.
So, to really cement the scale of this for our MBA listener, let's walk through the top 10 mega deals from this textbook. Knowing the context of these deals gives you the grounding you need for modern valuations. Let's start with the absolute titan. Tata Steel's mega takeover of Chorus for $12.2 billion.
Yeah, the biggest ever for an Indian company at the time. It really marked India Inc.'s arrival on the global stage.
Right, and the strategy there.
It was a play for global scale. Tata Steel was highly efficient, super low-cost raw materials. Chorus, this legacy European giant, had massive capacity and access to European auto markets, but higher costs. The idea was to feed Tata's cheap raw materials into Chorus's high-end European finishing mills.
Classic synergy play. Okay, deal number 2. Vodafone's purchase of a 52% stake in Hutch SR for roughly $10 billion. Now, this is a crucial distinction. Vodafone didn't buy the whole thing. SR kept 32% in the joint venture.
Which perfectly illustrates that you don't need 100% equity absorption. You are buying control, not total ownership. Vodafone wanted into India's exploding wireless telecom market. By taking 52%, they get operational control, but leave Essar with a huge minority stake to share the ongoing capital expenditure.
Because telecom infrastructure is wildly expensive.
Exactly.
Deal 3. Hindalco, part of the Aditya Birla Group, acquiring Novelis for $6 billion. This is upstream and downstream integration, right?
Yes. Hindalco produced primary aluminum. Novelis was the world leader in aluminum rolling, making the flat stuff for beverage cans and cars. Hindalco essentially bought a permanent global customer for its raw material.
Which insulates them from commodity price swings.
Smart.
Moving to number 4, and this is the cautionary tale we open the deep dive with. Ranbaxy selling to Japan's Daiichi for $4.5 billion.
Oh, this one is brutal.
Yeah, the Singh brothers sold to Daiichi, and the textbook points out this ominous detail that basically no real good news has come out of Ranbaxy since. The strategy looked great on paper, though, right?
On paper, sure. A Japanese innovator drug company buying an Indian generics manufacturer to diversify as patents expire. But Daiichi bought into a company falsifying data. The US FDA banned imports from Ranbaxy facilities. It's the ultimate lesson that strategic rationale means nothing if your due diligence fails.
Absolutely. Deal 5 shifts us to geopolitics. ONGC acquiring Russia's Imperial Energy for $2.8 billion.
Right, this is a strategic turnaround for India's hunt for natural reserves to compete directly with China. When you're state-owned like ONGC, your M&A strategy is dictated by national energy security.
Deal 6 is NTT Docomo and Tata Teleservices for $2.7 billion. Japan's Docomo bought a 26% stake. Keep that 26% number in your head, listener. We'll get back to why that specific number is a big deal legally.
Yeah, that deal brought advanced 3G tech to India, but eventually ended in a messy legal dispute over exit valuations.
Always negotiate the exit. Deal 7, HDFC Bank and Centurion Bank of Punjab for $2.4 billion. In banking, it's usually about branch networks, right?
Exactly. Building branches organically takes decades. HDFC bought Centurion and instantly expanded its footprint and retail deposit base.
Deal 8, Tata Motors acquiring Jaguar Land Rover for $2.3 billion. The textbook warns this highly ambitious deal landed Tata Motors into a lot of trouble. It's a huge lesson in the risks of prestige buys.
For sure. Tata was known for ultra-low-cost vehicles, and suddenly they own struggling British luxury brands right on the eve of the 2008 financial crisis. The integration risk was astronomical. They survived, but it was incredibly close.
Deal 9, Suzlon Energy and Repower for $1.7 billion. An Indian wind energy company buying German turbine tech.
Pure intellectual property grab. They needed the German engineering patents to compete globally in offshore wind.
And finally, Deal 10. Reliance Industries taking over Reliance Petroleum Limited for $1.6 billion, or about 8,500 crores. This is unique because it's intra-group. Why spend $1 billion to buy your own subsidiary?
Because a fragmented corporate structure leaks value. Absorbing it eliminates duplicate taxes, streamlines cash flow, and creates a better balance sheet for raising cheap debt.
Okay, so we've seen the scale of these deals, but we need to establish some absolute structural precision for our MBA students. We throw around merger and acquisition, like they're the same thing.
And they really aren't.
Right. So direct question from the textbooks, check your concept section. Differentiate between merger and acquisition. Let's tackle the merger first.
Mechanically, a merger is the combination of two distinct entities into one single new identity. It's not just adding up assets, it's forming a new entity. In a true merger of equals, two roughly equal-sized firms pool their interests. The stock certificates of both original companies are surrendered.
Wait, so the old shares just cease to exist?
Exactly, they are canceled. And brand new stock is issued for the newly formed corporation. Let's call it Corporation AB. Maybe it's a 40-60 split of ownership. Alternatively, you have merger by absorption, where one firm is completely absorbed and entirely loses its legal identity.
Okay, so contrast that with an acquisition. This is where one company takes effective control over another, but they don't combine into a new legal entity.
Right. In an acquisition, the acquired firm's stock isn't surrendered. It's bought by the acquiring company and continues to trade, or at least the target company continues to exist as a legal subsidiary. The acquirer keeps its original identity.
So company A buys company B. A is still A, B is still B, but A now pulls all of B's strings.
Precisely. And this is where we get into hostile versus friendly. A friendly deal is mutual negotiation. A hostile takeover is buying the company against its board's will, usually by going straight to the shareholders. And remember, you can get effective control just by holding a minority ownership if the rest of the shares are super dispersed.
Here's where it gets really interesting. There are 4 structural forms of mergers. I'm going to list them, and I want you to give our listener real-world analogies to memorize them. First up, horizontal mergers.
Horizontal is when you merge with a direct competitor in the exact same market, like ICICI Bank and Bank of Madura. The goal is simple. Grab market share and brutally cut duplicate costs. You don't need 2 marketing departments if you're selling the same thing to the same people. These often take the form of hostile takeovers.
Right, and they trigger a lot of antitrust scrutiny. Form 2 is the vertical merger. Another check your concept question here. What are the advantages of a vertical merger?
It's all about extending your supply chain. So imagine a steel company merging with a car manufacturer. That's a vertical merger. The advantage is that you secure your supply lines, you lock in your costs, and you freeze out competitors who might need that same steel.
You build a moat. Form 3 is the co-generic merger. This one is a little trickier. Same general industry, but no direct buyer-seller relationship.
Right, so they aren't competitors, and it's not a supply chain thing. The goal of co-generic is leveraging the same sales and distribution channels. Think about a premium shampoo company merging with a premium toothpaste company.
Oh, I see. They don't compete, but they sell to the exact same high-end pharmacies.
Exactly. They use one massive sales force to push both products to the same target customer.
That makes total sense. Okay, the fourth form, the conglomerate merger. Answering another textbook concept check. What do you mean by conglomerate merger?
This is combining totally different businesses. An aerospace company buying a washing machine manufacturer. The theoretical goal is sharing assets and reducing business risk. If airlines stop buying planes, people still need clean clothes, right?
I mean, that sounds great in theory, but I have to push back here. What are the risks? If the new company gets too large, doesn't it just become a bloated mess? How does an aerospace CEO know how to sell washing machines?
You've hit the nail on the head. That's exactly why conglomerates often fail to blend successfully. Central management lacks the specialized expertise. The capital allocation gets inefficient, decision-making slows down, and the whole thing ends up trading at a massive discount.
So we know what these beasts are. Let's pivot to why executives go through the massive headache and expense to execute them. We have the 8 strategic rationales, the 8 whys. Number 1 is growth, and number 2 is market power.
Right. External growth is mathematically just way faster than internal capital projects. You buy the factory instead of spending 5 years building it. And market power, that leads to monopoly pricing power, better product differentiation, and overcoming barriers to entry.
Number 3 is huge for MBA exams, corporate tax savings. Can you give us a deep dive into the financial mechanics here? How does buying a company save you taxes?
It's all about the purchase price allocation. Let's say the target company's market value heavily exceeds its net book value. As the acquirer, you can legally write up the value of those assets on the balance sheet.
And because the asset value is technically higher now, you can charge that difference to depreciation, right?
Exactly. And depreciation is a non-cash expense that reduces your taxable income. It creates massive tax savings.
But the crucial exam distinction here is about goodwill, isn't it?
Yes, absolutely. Write this down. Goodwill is never tax deductible, but asset write-ups are. That's why deal makers fight to classify premiums as tangible asset write-ups instead of just goodwill.
Reason number 4. to acquire needed resources. This isn't just about factories or land, it's about patents, trade secrets, and importantly, people. There is a fantastic quote in the source material from former Cisco Systems CEO John T. Chambers. He said, "Most people forget that in a high-tech acquisition, you are really only acquiring people. We are acquiring futures."
That is so true in tech. You do an acquire hire. You pay $1 billion not for a startup's current revenue, which might be zero, but for the exclusive loyalty of their 30 genius engineers.
You're acquiring their brains. Reason 5 is diversification.
Which, like we discussed with conglomerates, reduces systematic and unsystematic risk, especially international mergers, which uncouple a company from a single economy's fluctuations and help bypass domestic regulatory restrictions.
Now, reason 6 and 7. I want to challenge you to clearly differentiate these two for our listener because they sound identical. Economies of scale versus operating economies. What is the mathematical difference?
Good question. Economies of scale is about distributing fixed costs over a larger production volume. So your unit cost goes down. If you have a factory that costs $10 million a year to run and you double the output by acquiring a competitor's orders, the factory still costs $10 million. The cost per unit drops.
Okay, so scale is purely volume leverage. What are operating economies then?
Operating economies is about eliminating overlapping functions. It's the cost cutting, firing the duplicate R&D team, centralizing the HR training, combining distribution channels.
Got it. Which brings us to number 8, synergy. We hear this buzzword constantly. I always think of the analogy 1 + 1 = 3.
Right, but people confuse synergy with operating economies. Operating economies, the cost cutting, is just one form of synergy. True synergy includes enhanced creativity, innovativeness, and a complementarity of skills that genuinely makes the combined firm vastly more valuable than the sum of its parts.
Like a biotech firm with a great drug, but no sales team, merging with a legacy pharma company that has thousands of reps, but no new drugs.
Exactly. Together, they create value that neither could achieve alone.
Okay, transitioning from the theoretical why to the very practical how. If our MBA listener is ever put in charge of a deal, they need to know the actual roadmap. The source outlines a brutal 7-step M&A process. This is basically a survival guide.
And you have to follow it carefully because one wrong move in this sequence can reverse all the benefits you just modeled on your spreadsheet. Step 1 is a preliminary assessment and valuation.
This is looking at current financial performance, future market value, business history, brand value, all that stuff, right?
Yeah, you're figuring out the absolute maximum price you can pay without destroying your own shareholder value. Once you have that, you move to step 2, the proposal phase. You send a non-binding offer document outlining your strategies and commitments.
And then step 3 is exit planning. This is from the target firm's perspective.
Right. The seller plans their exit. Are they selling fully or partially? What's the tax planning? What are the reinvestment options for the founders?
Step 4 is the structured marketing process.
This is where the seller creates a confidential information memorandum, or CIM, and company profiles. They strictly guard the selling price, force serious buyers to sign non-disclosure agreements, and eventually develop a final letter of intent after negotiations.
And then we hit step 5. Buyer due diligence. Let's actually pause the timeline here to drill down on this because it is the crucible of the whole process. How does the textbook define due diligence in a corporate law context?
It defines it as the level of judgment, care, and prudence required to thoroughly investigate a corporation. It's opening the books.
And what specifically are we checking? Because it's not just making sure the bank accounts match, right? For an MBA exam, what's the checklist?
You are checking everything: debts, pending or potential lawsuits, leases, warranties, employment contracts, tax liabilities, the whole HR environment.
And crucially, the information systems, IT integration.
Oh, yeah. If they use a custom, outdated IT system and you use SAP, integrating those could cost hundreds of millions and paralyze operations. You have to know that beforehand.
Okay, assuming you survive due diligence, step 6 is the stage of integration.
Yep. Preparing the closing docs, signing everything, and legally defining the future relationship parameters.
And finally, step 7, operating the venture.
Which is actually fulfilling the predefined expectations of the deal. Migrating the systems, handling the culture clash, realizing the synergies.
The actual hard part. Now, to wrap up the curriculum, we have to talk about the rule book. M&A isn't the Wild West. You have to play by the rules of the country you're operating in.
If we connect this to the bigger picture, the regulatory framework is what keeps this chaos from crashing the economy. In India, there is a whole alphabet soup of primary regulators: SEBI, RBI, FIPB, CCI.
Let's break down the specific laws, starting with the Companies Act 2013.
That's the bedrock. It governs the Indian court-sanctioned schemes for mergers and demergers, the actual mandatory legal procedures.
Then we have the SEBI Takeover Code of 1994. This is basically the math of a takeover.
Exactly. It dictates how you can consolidate voting rights. Say you own 15% of a company. You can consolidate up to 55%, but there's a strict cap, a maximum of 5% per financial year.
And if you go over a 26% stake, it triggers a massive notification procedure, right?
Yeah, 26% is the magic number. In Indian corporate law, special resolutions require a 75% supermajority. So if you own 26%, you have a veto block. You have negative control. SEBI says if you hit that threshold, you must make a mandatory open offer to the minority shareholders to buy them out.
Makes sense. Next is the Competition Act, 2002.
Overseen by the CCI, the Competition Commission of India, this is antitrust. They control the abuse of dominant market positions. Large deals require their prior approval, even if the deal is taking place outside India, so long as it impacts the Indian market.
Global reach. We also have the Income Tax Act, 1961.
Which evaluates the tax consequences. For instance, an asset transfer via a slump sale, selling the business as a single going concern, can result in different, sometimes higher income or value-added taxes for the seller compared to an itemized sale.
And lastly, FEMA, 1999, the Foreign Exchange Management Act.
Governed by the RBI, this sets the guidelines for issuing shares to foreign entities, which was obviously crucial for that cross-border boom we discussed in Section 1.
Okay, we are in the home stretch. We're going to do a lightning round for our MBA listeners' memory banks. I'll throw out the exam key terms, you define them. Ready?
Let's do it.
Hostile takeover.
Unfriendly, strongly resisted by the target company's managers and board.
Reverse merger.
A robust private company buys a failed, empty, public shell company to instantly go public without paying for an IPO.
Dilution.
The reduction in stock value or earnings per share when a company issues more shares to pay for an acquisition. The pie gets bigger, but the slices get smaller.
Holding company.
An entity that doesn't produce anything itself, but owns more than 50% of the voting power in other operating subsidiary companies.
Takeover bid versus tender offer.
A bid is just the general intent to take over. A tender offer is the aggressive mechanism of going directly to the target shareholders and offering to buy their shares, usually for cash, without the board's consent.
Swap ratio.
The calculated exchange rate of shares in a merger. Based on valuation, it dictates how many acquiring shares you get for your old target share.
Liquidation value.
The absolute floor price. It's the estimated asset value if the company was sold off for scrap cash today, ignoring all brand value or goodwill.
And finally, amalgamation.
The legal blending of companies where shareholders of the old companies become shareholders of the new entity, very similar to a merger in structure.
Amazing. So what does this all mean? We started by unpacking India's massive M&A boom in the LPG era. We learned the hard legal distinction between absorbing a company in a merger and simply taking control in an acquisition. We explored the 8 strategic reasons driving these deals, the brutal 7-step execution process, and the strict legal framework, from SEBI to the CCI, overseeing it all.
It is a massive amount of corporate machinery, but I want to leave you, the listener, with a final provocative thought to mull over. We talked about John T. Chambers and acquiring futures rather than market share.
Right, the acqui-hire concept.
Yeah. As we move deeper into a purely digital, AI-driven economy, will the future of M&A completely abandon the valuation of tangible assets like plants and equipment?
That's a huge question.
Think about it. Will we see mega mergers where $1 billion is spent solely to acquire a specific AI algorithm and the 10 human minds that understand it? If that happens, it completely redefines our foundational concepts of liquidation value and due diligence. How do you audit human potential?
When the assets are literally intangible thoughts and code? Wow. That is something to think about as you build your financial models. Good luck on your MBA journey, good luck on those exams, and keep diving deep into the world of corporate finance.